Well, Tamir, I think geopolitics is always very difficult to predict. So I think this was obviously unexpected escalation, but it's very difficult to say what to do. For example, do you actually add to your positions in oil at this point when everybody in the world is actually making huge profits? And any further surge in oil prices will probably meet with demand destruction. That's probably not the best thing to do. We actually think that at this juncture, it's relatively low vol, and the yields have popped quite a bit recently because of inflation and growth in the U.S. being so high. We actually think it's probably the best time to actually hedge your portfolio a bit, buy some protection for the U.S. market in terms of puts and so on, and also look at adding to your positions in Treasury while the 10-year is closer to 4.5 and the economy is still very, very strong. We think that looking forward in the next 6 to 12 months, the risk reward to owning things like that will probably be better versus adding to things that have already popped recently because of unpredictable geopolitics.
Got to get back to what you were suggesting when it comes to the yields. Aren't you worried about getting caught off sides, considering the indigestion that the markets already currently have when it comes to duration on the US side? And if we're trying to maybe game it out a little bit as well, if we were to see a worsening situation or even just any kind of normalization, you'd imagine that the short end would be coming in first, and there's still the case to be made that if everything's so resilient in the US, that the long end could continue to track high of 5% plus?
Yeah, I think it depends on your time horizon, right? I would say, in terms of year to date, clearly at the beginning of the year, people were looking for a very substantial amount of rate cuts this year. And now the number of rate cuts expected has shrunken from something like 6 to 2. So the short end has definitely suffered on the back of that. And I would say the expectation now for rate cuts this year is pretty tight because of the stickier than expected inflation, as well as the much more robust versus expected, fundamental in terms of underlying payrolls, et cetera. But if things do start to shift, then yeah, you're right. Probably the short end can move first. But I do think that over the medium to longer term, obviously the long end probably has more room to perform and give bigger returns on an absolute basis. So I would say there could be a combination. I would say the short end, the room to move is probably a little bit less, right? So for if you want kind of medium to longer term hedging to lock in like 4.5% or somewhere thereabouts, then I would say probably 5 to 10 year is probably a little bit better versus the very short end.